Heavenly Father, thank you for bringing us all here in good health, and we ask that you provide us all some wisdom, some guidance, and a little bit of education today as we deal with one another, and give us a long pause and make us thankful for the things that we have, the things we take for granted, Lord. We ask these things, and in your Son's name we pray. Amen.
Pledge allegiance to the flags.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Honor the Texas flag.
Pledge allegiance to the Texas, one state, under God, one and indivisible.
Any comments from the public? No. Consider an act on adjustments to or relief from the specific charges imposed by the district. No, good. Okay, the consent agenda. We have items 1 through 9. And anybody want to point those items out? No. So can I have a motion to pass 1 through 9?
Five motion to, 5 to.
Oh, 5 through 9. Excuse me.
Yeah, 5 to.
Have a second?
Second.
Second. All in favor, say aye.
Aye.
Okay. Receive the regular monthly SRA Woodlands Division report.
For our reports in your packet, beginning on page 20, running through page 28, we do have nothing out of the ordinary, no violations. We are closing one project, which is the waterline condition-based assessment. That project was done last year and all invoices have been paid, but outside that, I'll be happy to answer any questions you have.
That question.
Yes, sir.
On the water loss report on page 21,
Yes, sir.
can you translate that percentage into dollars?
I can tell you roughly when we did the budget, every 1% was about $100,000. So we assumed going in at a 4% loss, we were going to lose $400,000 worth of revenue. So assuming you're looking at the 6.96%, give or take 700,000.
Okay.
Roughly.
And I just want to reaffirm, just for my own peace of mind, that's on the SJRA side, correct? The water loss?
No, it's through the whole system.
The entire system.
So
Right.
who takes the hit for that financially?
It's already included in the rate. So there's no actually invoice or anything that goes through that says, hey, here's the 700,000. It's just a loss at the end of the day.
Okay. How are we progressing on the investigation? I mean, I've heard the same thing for 4 months. We're looking into the software. I come from a background where a small leak could be catastrophic, and we have ways to isolate those leaks.
It's not a leak, although the leak losses that so S-Tray tracks losses for brakes on their side, we do it on our side. Our information is not in this chart. Also, if you look at the chart itself, the high months are surrounded by 1%, 3%. So if we look at the average of those, you know, the budget is on 4. We've been hovering around 5 over the last year or so. And the balancing of all that is actually 6. So even though those spikes are there, some of that we've identified as the losses need to be included in this chart. Some of it is the spikes and drops are the timing of when they read their meters and when we read our their meters at the water plants coming from the wells, et cetera, versus when we read all of the customers' meters. There's a timing gap. So that's part of where these whips are. We also identified that and this was a good thing, that when we dug, we identified there was a couple accounts. Again, we went live with the new software in March of last year. So everything was going decent. But there was a couple accounts that we found that actually didn't get billed. So we've corrected that. So that'll jump back in there. So
For them.
all these little pieces, I think, are accounting for, you know, the eventual loss. So the spikes look weird, but if you look right beside it, there's an abnormality of a low percentage against the norm, which is around 5, and then all those start to average back down.
Okay.
So
2 more questions. on right next door, on the chart right next to it, those flushes, are they scheduled?
The EST, yeah, those
Okay.
EST sevens, water tower drainings, they were, because we're having condition assessments done. And they have to enter the bowl of the tank, the inside, and actually inspect every part of it to know when we have to rehab them. And so we had to drain them all for that. So we did plan them out once a week for the past 6 weeks.
Okay.
And those are required by TCQ on what interval?
So these are not required. Annual inspections are required, right? But we drain them once every 7 to 10 years. I think the last time was in 2015 to determine when we have to actually repaint them for the next 10-year period.
Okay.
So.
So in a perfect world, I'm just dreaming here. Could everyone in the district open their water pipe and get free water for, say, 1 or 2 hours while you're trying to flush that tank?
Not entirely, because what I'm trying to do with this flushing is get a lot of the sand and stuff that's built up in the bottom of the tank out. So I have to make sure I have water continuously flowing through, because if everybody opened their tank and I basically just let it drain in the system, all that gunk,
Sand would stay in.
it's going to stay in, but it's also potentially going to get sucked into the system itself.
So you have to drain it into the service.
Yeah.
Okay. And then the last thing, Eric, I noticed on that graph, that groundwater, surface water production trends, I think the fiscal year groundwater and the budgeted, you've got it at 65 and 45%. I hear.
It's SDRA's report.
Which page are you on?
Okay, on page 20.
Yes, sir.
I've got the budgeted groundwater, freshwater mix at 65-45, or is it 55-45?
The annual budget's 50-50 at this time.
Okay.
Proposed for FY 27 is 65%. Well, no, it's not even then. It's 58. And you don't talk about that.
Is it, so is that graph
It fluctuates,
premature?
it fluctuates per the season, so it'll go up and then it'll go down. And the average is, the target average is 50-50.
Right.
So when are we take?
That's not what the graph says. The graph says 55-45.
Oh, yeah, it's 55-45, correct, in the month. I'm sorry. I thought I heard 65 when I was looking for.
You've got two tongues.
So yeah, throughout the year, just like Eric said, it's going to fluctuate. Jason back here has been making changes, so it's more where you take more water, surface water in the winter time. Before, years ago, we used to take more winter. The winter used to take less. Now we take more in the winter, just to kind of average out the plant's production. But yeah, so every month you may be 55 one month, 40 the next, just depending.
50.
But then if just to offset that, if you look at page 21 at
Yeah,
the top.
50-50 over here on the next page, but on the previous page on that graph, it's 55-45.
Yeah, the budgeted, okay, and you don't have the budgeted for the per month on that table on the top of page 21. But what we've broken down on the page 20 with the dotted lines, dash lines, that's actually the monthly budget that equals the annual budget of 50-50.
All the questions.
Thanks. Anything else?
I can cover the Bear Branch briefly,
Yeah,
if that's
please
okay.
do.
Ed had to step out. I'm not nearly as informed, but I will tell you the two things I do know of. One is the $5 million for the Bear Branch Dam has been approved by Congress. And so right now we're going to be working on the agreement with the Corps to get that money to y'all or to us for that project. So that's good news. That's a total of 8.6 that's been given by the government for that, federal government for that. The second item is on page 45 and 46. I'm not going to say it as well as Ed did, but basically, taking heed from what Woodlands Water did with all the ditches around the area, the Bear Branch Division went out and checked all the outfalls throughout the Bear Branch system. That's what you see on 45. Red, yellow, and green dictating basically the condition that you can see on page 46. And so they do have money in this fiscal year's budget to do some of this work. So I think it's about $25,000. And then they are looking to use the $25,000 in next year's budget to do the rest of it. And then they're going to continue to monitor and improve as needed.
Why did the Conroe Lake Division do this analysis. I thought, that's not the normal division.
No, the Bear Branch division is within inside the Lake Conroe division.
Oh, yes, yeah,
Because the Bear Branch Dam and Lake Conroe Dam go hand in hand.
okay.
And so I've asked twice to have it and they said no.
Yeah, so. And then I guess if you notice, we don't really have any red dots that are associated with 46. Good.
And the percent is the percent of height of silt? So if it's 80%, it's 80% of the horizontal? Okay, got it, thanks.
That's all I have.
Okay, consider an act on pay application number 6 for the retail wastewater collection system rehabilitation year 2.
Yes, there was a estimate of which 46 didn't have any work done in that particular estimate, so no motion there. The next item we do though, it's change order number 2 for the same project. And that change order is to extend the contract time to June, so the contractor can finish the project, no expense, extra expense.
So we need to pass a motion approving that.
Yes.
I make a motion to approve.
For a second.
Extension.
I'll second. Change order 2.
Do we need to approve each one or can we approve both of them at
But
once?
the other one, you didn't have any no work with that,
Okay.
just the change order 2.
So to finish my motion, I make a motion to consider and approve item 12, the pay application number 6.
A second. Second. All those in favor, say aye.
Aye.
So we didn't have anything in 13 then, right?
Well, actually, 13 is what you needed to approve. It's change order number 2.
Did we do that?
You didn't have any work in that.
Okay, so when do we
All right.
raise that, Tom?
I'll make a motion to approve item 13 on the agenda.
I'll second.
All those in favor, say aye.
Aye.
Okay, receive and discuss supplemental agreement for the SRA for the issuance of bonds in connection to Tier 1 water line renewal project.
Okay, we're referring to this, SJ provided this, this is the 10-year outlook on, estimated 10-year outlook on the renewal project. And this includes, so the Tier 1 and Tier 2 projects that came from the HDR report were previously identified to be done in the next 10 years. So this kind of tries to plan those out roughly. And the first 2 projects, which are the 2 Tier 1 projects, Town Center and Woodlands Parkway, will be identified to be in the first 2 tranches of bonds. If you recall, when we were going through the HDR report, we were talking about these spurs or these extensions. And we identified that some of those may not really need to be done. What you see on here as supplemental lines, it's referring to those. So supplemental lines are not included in the Town Center and Woodlands Parkway under these 2 bonds. They would be identified or reevaluated, as we talked about a couple of months ago, to relook at, the Tier 2 projects to kind of line out, what needs to.
So what you're saying is that the Tier 1, $18 million for the supplemental line is not in the bond. They're just left out. So all we're including are the major,
Just the base.
just the base project. Okay.
Not the supplementals. That's correct.
It's in the draft of the supplemental that you received, but we're moving that down on our comments to that supplemental agreement, moving that down on Exhibit A from Tier 1 to Tier 2.
Right. In the draft, it's right there in Tier 1. It's going to be dropped down to 2. It just was put in the wrong.
So just the comments, so if we go back to the HDR project or that sheet out of Dave Spencer's consulting agreement. So the price he had for there for, let's just take Woodlands Parkway, for including the whole project, right? Was 27.8 million. And now that's, if you add, that included both the both the subline and the main line, it is now 51.7. So we went from 27.8 to 51.7. And almost all these costs have doubled from from this sheet, from Dave Spencer's report. I was kind of really surprised by that they could.
There are quite a few things that were not included in Dave Spencer's HDR report. One is land acquisition, two is design. They also use 2025 dollars. And so as we push this out 5 years, we did have to inflate the number to account for it. Like, he did.
And it was land act, it was also missing land act.
And design. He was just issuing, I'm sorry, and contingency. He was issuing contingency.
Contingencies.
He was utilizing just strictly construction cost. Everything else was added per normal procedure that we do on the project plan.
Question. Is there a list or schedule that shows the pro rata distribution of the cost of all of it? Because for the total, it comes out to 140 or 144 million. Is it broken down by months?
This is put into the wholesale rate, so it's actually put into the wholesale water rate. So it's based on the consumption of water demand in the districts.
And that's for what projects? That's for the first two?
That is for the first two.
First two decision that we made was to put that in water rates.
Correct. This agreement would be going into the wholesale water rates. From us to you, how you pay for it is
Does the river authority maintain any kind of reserve to cover infrastructure repairs?
to a certain degree. We do. The emergency reserve is the biggest one. That's just below $3 million. The R&R is another reserve. I'm sorry.
It's just a drop in the bucket, projects like this.
Correct. Yeah, to fund these cash, as you notice, have gradual increases. You would have been funding it for the last 10, 15 years slowly, which we would have been then holding on to $150 million worth of money.
Okay. Who owns your assets?
The River Authority.
Okay, so help me understand this. Why are the funds taking out loan to cover infrastructure costs that they don't own?
The MUDs will not be taking out loans.
Or issuing bonds?
Well, they're not. So.
The SRA is, and they pass it through to us, but we guarantee it.
No, we do not.
Really, this contract is, bond or the amendment, shows that we do guarantee it.
It says that the obligations are of the,
Secured by,
Yeah, I agree.
they're obligations of the river authority and not, where's the letter? Not of the districts. Anyway, go ahead and keep asking your questions. I'll
Okay,
back up on.
Adam, I have a question for you. Can you tell me why we are allowing the SJRA to issue these bonds when we could be getting bonds from the Water Development Board? What advantage is it?
So currently the open market, so you can go to the Texas Water Development Board. There's a lot more bureaucracy and the rates currently, the open markets are better than Texas Water Development Board. They released weekly rates. And so
Okay.
SJRA, when it seems logical to go that route, then SJRA has the ability to also go to the Texas Water Development. But in this instance, Center River Authority doesn't meet, there's a ranking system that the Texas Water Development Board ranks every project, and this project just doesn't rank for the Texas Water Development Board.
We applied.
In the past, SJRA has applied. And it is, as Texas Water Development Board looks more towards, I hate to say, blighted projects first. The average income for the wood is significantly higher, which pushes you down on the ranking list.
So they're gonna guarantee months that may not have the bond rating that we would have.
Yeah, and
They was funded.
average income is significantly lower, so they're not bringing in the revenue that you could be bringing.
question building on Tom's time. What is the current rate that this bond would probably be issued at?
Low fours.
Okay. And we have an outstanding draw on current bond, I believe, Maureen, correct me, $7 or $9 million, something like that. And what would that rate be?
in total about 32 million.
Oh, is it really in total?
Yes.
That's open, that we can still draw
Oh,
upon.
no, I'm sorry. I don't
Yeah.
have that number. I'm sorry. I thought you meant remaining.
No, no, no,
Remaining
no.
outstanding.
We issued bonds, but we
I
didn't
know.
fully execute against them. And I thought that number was somewhere between $7 and $9 million.
Oh, you spoke about
I'm
that.
gonna speak after.
Yeah, no, but I'm saying let him add to that.
Yeah, so just kind of coming back to Tom's point and want to kind of expand on that point a little bit more. So first of all, source and security for payment of the bonds, section 5, customer and the authority agree that the bonds shall be limited obligations of the authority and not obligations of customer, payable solely from and secured solely by a pledge and the lien of the net revenues of the water supply. So clearly, these are only obligations of the river authority that are limited to a particular revenue stream, which are the water, wholesale water revenues of the river authority. So, and we've done this, the most.
All of the supplemental agreements, just about.
Well, we've done this on the rehab and rehabilitation one other time. So historically, there was a structure in place for the river authority to be able to issue bonds on behalf of the MUDs for new infrastructure. You know, as you were expanding out the system, as the district, as the Woodlands was being built out, but there wasn't a mechanism by which the river authority could issue bonds in place of the MUDs for rehab of older infrastructure. The way historically repair and rehabilitation was handled was on a cash basis. So as funds needed to be, as projects need to be rehabilitated, the river authority would include incremental amount and wholesale rate to get a pay for that. In 2016, we had the first time where the cost of the rehab and rehabilitation that was needed was so significant that it would have been a pretty, onerous increase in the wholesale rates and therefore the retail rates to customers to do it on a cash basis. And the useful life of the assets post repair rehabilitation was long enough that you could match it up with a maturity schedule for a bond issue. So it made more sense to have all the people who get the benefit of that asset over its 20, 30, 40-year life to pay a piece of that, cost versus just having whoever lives there the day that the repair is done has to pay 100%, even though that asset will still be in use probably years after they move away. So we put into place with the river authority and the MUDs a structure by which bonds could be issued for those rehab and replacement projects. This new supplemental agreement is the same structure as that 2016 supplemental agreement with what I'll call four differences that I've been pointing out to districts. So one is that the supplemental anticipates 2 bond issues as opposed to back in 2016, there was only 1. That's just breaking the tier 1 projects into 2 bond issues as shown on this top of this color coded spreadsheet. So that's one. There's 2 bond issues. There's a maximum amount. First bond issue is going to be issued within 2 years. Second bond issue is going to be issued within 5 years of when the supplemental is approved. That's first difference. Second is that the original supplemental allowed for the inclusion of capitalized interest in the bond proceeds, basically meaning that the first 2 years, up to the first 2 years of interest on the bonds could be included in the proceeds you receive from the purchaser of those bonds. And so instead of, having a wholesale rate that has to include the interest portion, you only include the principal portion. It reduces the amount of the increase in the short term for the wholesale rate, but in the long run, you end up paying more interest. So this time it was taken out. So there's not going to be capitalized interest that will help to reduce the overall amount of interest paid. The third difference, almost done. Third difference is that the maximum maturity schedule for the bonds, either series, was reduced from 30 years to 25 years. The numbers y'all have there are that Adam ran are based on a 20-year maturity schedule. Again, the shorter the maturity schedule, less total amount of interest that gets paid. So that maximum was reduced from 30 to 25. And the last difference is that there is, because there's 2 different bond issues that will be issued over a period of years, there's a provision at the end of section 4 that allows, that provides the audit committee of Woodlands Water with the ability to provide input on the pricing terms to the River Authority before they go to market. So other than those 4 items, it's the same structure as what was utilized for that first rehab and rehabilitation bond issue. So
I want to
questions.
step in.
Yeah,
Do you mind if I go first?
please.
Thank you very much. I just want to draw attention to pages 3 through 5. The scheduled interest total, just ballpark, I did the 17 million plus 16 million plus 18 million plus 21 million. I just want to draw attention that the interest payments alone, the scheduled interest payments alone add up to 72 million. If you do the same calculation on all of these pages, basically rounding down to the nearest million, 32 million principal, 30 million principal, 34 million principal, 39 million. The total principal amount is 135. So the scheduled interest payment percent is 50. It's over 50% in interest payments that are scheduled to be paid if we adopt the scheduled
That's not so.
payments. It is, this is the paperwork. Right here.
You're adding up two.
I'm adding up the column.
No, but you're adding up.
I think the last 2 pages you can tear off and track.
Okay, so if I tear off those 2 pages,
It's just,
the first 2,
correct.
okay.
Those are the only ones that we're working on.
No problem. So cut the numbers both in half and you're still going to end up with about 50% in scheduled. The scheduled interest payment will be about 50% of the principal. So what I want to draw attention to is that I want to get on the record clearly that banks will recast the loans that they issue from a liability side of the ledger, from an accounts payable. When they issue the loan, they recast it as a customer deposit. And therefore, you have the creation of credit ex nihilo in the form of a bank. When you look at the bank internally, this is just 101 of banking, but not many people know this. The reason I'm bringing this up is that we have approximately half of that, so 35 or so million dollars that are scheduled to exit the community to unknown bondholders who will ultimately purchase this. And there's an alternative in the form of the State Bank of North Dakota that is an issuer of bonds. And so these people in the state are able to benefit from receiving those interest payments. So I just want to encourage the rest of my peers to consider a longer term alternative, which involves receiving the funding from a Texas-based entity, as opposed to an unknown set of outsiders which will purchase our bonds, so that the dollars flow within our community.
Fred? I have a question too, but I'll wait till you
No,
finish
I'll
yours.
defer to you.
No, you sure?
Sure.
So I just have a curiosity question. So these are municipal bonds, right? So they're federal tax free, exempt. And if you, again, you have to tell me, I don't know the answer to the question, but if I go up to New York, out of New York, and I buy a New York municipal bond, it's triple exemption, right? State, county, state, city, or county, and federal. So it's a triple exempt bond. So the question I have is, if you live in another state that doesn't have a income tax, right? So if you look at people who would like to, buy these municipal bonds, most likely they're not going to be people from states who have an income tax.
Yeah, I mean,
Right, because they don't allow this exemption, Texas exempt bonds to be deducted from their income tax.
and I mean, depending on if we go out and SRA goes out to competitively bid them, the initial underwriter that purchases them has the ability to sell it on the secondary market to whomever is a qualified purchaser. There's no way to dictate
Right.
that they have to use or to sell only to Texas residents.
The catch is that the people most likely motivated to buy these bonds are going to be Texas residents or residents from states that don't pay income tax. Right, because they get the standard federal deduction.
In other states that don't have.
Don't have income tax.
Yeah.
So, I mean, I don't know how you control what you're asking for, but
No,
I'm
what-
saying
I
the
think
motivation is that Texas is going to buy them, or Florida's going to buy them, or Tennessee's going to buy them, but I doubt New York was going to
Pension
buy
funds
them.
are buy them, or teachers unions are to buy them. The point that I think Joseph is making is one that he and I discussed early last year, in which when you go out soliciting bids for the bonds to include other entities that would benefit the state or the local as opposed to the normal investment community. Not to say that you exclude them, you add new ones. Is that what you were trying to
It
get?
was something more fundamental that I think that, I think of a municipal bank whose charter it is to issue the credit for infrastructure projects, so that the creation of the credit out of nothing, ex nihilo, and the interest that's gathered just flows into the entity that was created in the first place for the public. And the State Bank of North Dakota serves as a model, and Tennessee is thinking about adopting another one. And so I'm just bringing this up because I think there's an opportunity for us, Texas, to do that.
Fair, okay. Any other comments? If you could please turn to page 3 and let me give some overview. Background, I looked at every single supplemental agreement and contract that Mud 46 has signed and executed since 1981 when it was founded. And I've presented in previous meetings over the last year and a half, maybe 2 years, problems I had in the structure with these agreements. I still have those problems. This agreement still maintains those issues. And I direct you specifically to 3 areas. On page 3, item number 2, a little bit above the midway, then number 3 below it. And then 3,
Fred, in the
On page 60.
60. Okay, thank you.
in the
Thank you.
package 3 of the
Yep.
contract, the supplemental agreement. I asked a question earlier about having a pro rata analysis by MUD of what our bond obligations are. If we look toward how this document is structured, going to item number 2 above, we're now being asked to put a deposit as a reserve for the SGRA, which is a relatively new point. And I don't understand why we need to prepay something where they have a lien against all of our income from MUD 46. I also take a look at item 3 before, that the cost issuance of the bonds include, but is not limited to, all the things that it says there. I've demonstrated in the past when looking at the cost structure, fully burdened cost structure of an SFDUE, that it in effect doubles over the term of the contract, the cost of the bonds. I don't see us addressing some flexibility for us. And item B, 3B below, it talks about 2 series of bonds that Brian did talk to or address, 75 million and 45. That is, I would assume, the total for all of the MUDs affected by this agreement in the Woodlands. Is that correct?
So let me just kind of back up there. So to touch on the debt service reserve, that is a reserve that is set up for revenue bonds that is funded with proceeds from the bonds. It's not additional funds that come from the MUDs. A portion of the proceeds from the bonds will go to fund that debt service reserve. And in the sheets behind that first color-coded sheet, you'll see that and part of that, let's just look at the first one, the 32.3 million. You'll see project costs and then the debt service reserve. So it's a 1-year reserve. And that's what bondholders typically want to see as giving them additional security that, they're not taken on too much risk by buying bonds and there not being an adequate reserve by the issuing entity to
1 or
pay.
2% goes around off there at 750 to 1,500,000 on the $75 million one.
Well, so let me back up. This is the reserve for any of the bonds that are issued pursuant to the supplemental agreement. So in B, what that's saying is that the districts are only authorizing the River Authority to issue up to 75 million cumulative in 2 series of bonds, neither of which can exceed 45 million. Right now.
75 and 45.
No. 75 is the maximum cumulative amount. Neither series can
Okay.
generate more than 45. Right now, on the sheets that Adam has prepared, based on current numbers, including the additional for contingency and all that you noted, the farm out of the bonds would be more like 63 million. So they've included an additional cushion in case, the cost estimates come back higher, what have you, that is the maximum cumulative amount of the bonds that are issued. So it's not 75 and 45, it's 75 max. Neither of the 2 issues that add up to 75 can exceed 45. And the point of that is really to not incur interest prematurely, because if you issue for the first bond issue, that will be construction for town center and then engineering for the second Woodlands Parkway, you'll be able to get a better sense and reduce that contingency is the hope, that contingency number for the Woodlands Parkway project will be reduced through the planning process on the funds from the first tranche of bonds, so that you'll have a tighter number for the second series of bonds for the actual construction costs.
Let's talk cash flow though, okay? We have the schedule of when those funds are needed in this document, which is fine, that's great. Given the comment earlier, item H on page 61-4 in the contract, item talked about 2 years of excluding interest payments on the debt service. My question is twofold. One, is this being depreciated on the rule of 72s, or is this first 2 years of no interest being accrued somewhere and will be added on to the remaining 23 years left to that bond for a 25-year term?
So that's not really what that's talking about. What section H is talking about is that the debt service for the bonds have to be level, except for the
I
first
understand the level nature of that. I got it. Okay. So what I'm questioning first, if that 2 years worth of no interest payment.
It's not necessarily 2 years of no interest payment.
Okay. Payments it's excluding the first years of debt service
Meaning
payment.
that the first 2 years may not be level. We can
Yeah.
get to that.
Yeah, so if you flip past this first page, if you look at this structure right here, this is your annual.
Okay.
So if you look at the annual debt service.
Yeah.
So you can see in that first year, it's just under $1 million, which is just interest payments. And then beyond that, you're going to be paying principal and interest. And level just means, in any given year, we're not more than, say, a bond
So
separate.
this isn't the rule of 72s then?
No,
Okay.
it just keeps
No, you
it
answered my
flat.
question. It's
It
fine.
keeps it flat.
Yeah, I still think on item B, page 60, of 3 of the contract, that there should be a pro rata analysis or chart showing how much each affected money is going to be paying. Because we're not paying, but 46 is not paying 75 or that would be helpful, I think, to future board members.
So what we talked about in some of the previous meetings is that the way that the districts will pay for this, as we talked about, would be through payment of wholesale rates through the River Authority. And Adam's done an initial estimate for the first tranche, that 32 million, that would show a 47-cent increase in the wholesale rate. Now, how the MUDs handle the payment of that is, it's something for future discussion. We talked about when the River Authority lowered the GRP rate, moving those 11 cents over to create an infrastructure renewal fund. So that handles 11 of the 47 cents. So now you're down to 36 cents for that first tranche. Eric is working with a consultant to do a rate analysis for our retail rates to see, what we may need to do to address our retail rates here in the summer as we get into the budget for the next year. So it's to be determined whether or not the recommendation from staff will be to pass on all 36 remaining cents in the rates that would be adopted this fall, or if you, I'll use a shorthand term, buy down some of the pennies in the short term with maybe some of the funds that you get back from the River Authority here in the next couple of months. You can, instead of doing, just making up numbers, just for sake of illustration, instead of doing 36 cents, maybe you buy down 5 pennies of it with some of that reserve, and you go up 31 cents in the first year, and then you get up to the 36 in the second year to kind of, make the increase a little bit more gradual. You're going to have that flexibility, but that's not being determined yet. What we talked about in some of the previous meetings was Adam and his group coming up with basically a one-pager for the boards to be able to see, okay, what is the number of penny increase on wholesale for the first tranche of tier 1 for the first bond issue and for the second bond issue. So you can see what that is, cumulatively.
The impact.
Correct. And I think that's your question.
That is my question, and I have other questions too, as well.
Can I add something to that?
Please.
So if you look at our budget between now and 2030, so right now we are paying 6 million a year in debt payment. That basically it ends 2030. Some of it ends 2027. So we're going to have that $6 million freed up, which we need a mapping to understand that. Plus, we're still paying $500,000 a year in our budget for the 2016 debt payment. So that ends by 2030. So we have a lot of debt, you know what I mean?
That will retire.
That will retire, that
Yeah,
will
we know that.
smooth this process out. And we just need to understand that as we go forward.
Well, we need to understand it and also rebuild the coffers to increase the amount of months that we can continue on, that we have in reserve for those kinds of unexpected issues that will come up, and they will come up. But that's something that we talked about when we made the decision to go from a undeveloped community to a developed district and reduce the rate that the Woodlands Water Authority can increase our taxes from 8% down to 3.5%. The concern that Eric had, rightfully so, was that, hey, you've only got 3 or 4 months worth of reserve. This, of course, the retirement of the debt should go to build up our reserve, not to necessarily smooth the issues that you're talking about. I mean, from my perspective, one of the reasons I joined this board was to protect the residents of this district. And my point is, on this supplemental agreement, I don't believe the way it's structured right now protects the best interests of the residents long term. Let's go to section 8, which is page 62 or page 5. And this is a freeze frame of something that I've been arguing during the developed discussion and arguments that we had, along with the review of the SFDUE pricing. The SGRA has got a long history of taking excess funds, excess revenues, and putting into their coffers approved by the trustees, not by the individual boards. I have a problem with that from a resident. I am a resident of this district, and I have a problem with that. So here again, we have another section that is not working in the best interests of the residents. It says that surplus construction funds, much like surplus revenues or excess revenues, I believe is how Chris described it when he presented it to us many months ago. They have now the opportunity to use it as they wish for tier 2 projects. My point is, a budget's been established. projects have been approved within a fiscal year, it's by the MUDs, that those decisions that we made have been overshadowed and circumvented by paragraphs like this, which remove the authority from the MUD boards and put it either with the trustees or with the opinions of the SGRA. And I have a real serious problem with it, and I would not approve this supplemental agreement based the way it's currently written.
So the surplus construction fund section was included in the original.
It's included a lot of.
Well, the one in 2016, that was the first one that dealt with bond issue for
You are
rehab
correct.
rehabilitation.
You are correct.
So there has to be a contingency plan for the bond proceeds. And what we're talking about here are only funds that would be remaining if the project as engineered and constructed comes in lower than what was anticipated and included in that bond issue. If there were funds remaining, but that's where
I understand what you're saying. I clearly understand it. My only point is, in a budgetary process, and I've been lectured on this before by other people in this room and elsewhere, that the MUDs, the WWA, the SGRA are not managed like businesses. They're managed like government agencies. And I think that in itself is an issue. The fact that there are excess bond proceeds, they should go back pro rata to the individual MUDs based on that previous chart that I had mentioned. I understand that the bonds are issued for certain items. I got it. I understand what Texas law says too. But the fact that we include something in here that if there is a surplus, it can be used for it. Any project that they say takes the authority, we approve a budget so they can do their job well. And they should be held to those standards.
Eric, you're shaking your.
I think he's about to ask.
Well, yeah, I mean, you can answer as well. I mean, the funds are not set aside to be able to use for any purpose. They're only allowed to be used for, that's the reason why tier 2 is even addressed in here. Now, tier 2 is going to get refined over time, but the point is that they would only be able to be utilized toward those tier 2 projects that have been reviewed.
Well, that's what it said here. Yeah, that's correct. Have been reviewed, but not approved by the MUDs because we have not done that yet.
Correct, and that will come over time as those seniors.
And who holds the funds and who gets the interest benefit? Okay,
The districts get the benefit of the funds that are held by the River Authority for projects that are.
I'm sorry, I didn't state my comment properly. While they're holding the fund, they're depositing it in pools of interest-bearing notes or accounts. That generates lots of income from what the prevailing rate is, and that's shown in this report too, that Maureen does every month, how much income we've made from the bonds, the money that we have put into investments. While the SGRA is holding this money, they're generating income, which theoretically should come back to lower. In a business world, that's how it's done.
Tax pool, isn't it called? Yeah, my understanding is what you said. Any depository accounts will have an interest on it.
Interest of the residents.
Yes, and I'd like to build on the, not in the best interest. I'm sorry. Go ahead.
No, and I want to make the last point, and I've brought this up before in the past. Can you show me where it shows how we pay the SGRA monthly? Because we did have something that I described as prepaying interest before it was due, or prepaying funds. I called it, thank you.
I remember your, well, it was your turn.
No, please say it.
Interest arbitrage.
Right, interest arbitrage. And I have a problem with that. So if we're paying 6 months in advance for X number of months in advance, then that money is being held by the SGRA, and on sums of money that's worth 100, 125 million, 150 million, that comes up to an awful lot of money that we are losing in our income. Yes, it is.
Well, so, right, so let me just let me just kind of step
Yeah.
back for a second. So any funds that are related to the bonds are required to go into a separate and be segregated into a separate construction fund account. They cannot be commingled with other funds of the River Authority. And this is the same for a mud bond issue. It's federal tax law. So they have to be segregated into a separate account. Any interest earned has to go into that separate account. And oh, by the way, the IRS says if you earn interest in excess of what the bonds were issued at, under the arbitrage rules of the IRS, you have to actually pay that back to the IRS. That's why for our mud bond issues, we have to track that. And now, unfortunately, we have, for years, it was an academic exercise. What we actually earned on interest was like, 1%. The bond issues were at 3 or 4%. Well, now, we had some bond issues around COVID that were, 2, 3%. And then the
Subsequent
rates.
interest rates going up.
Exactly. And so now we're actually having districts.
No
that
longer
are
theoretical.
paying excess, but you don't get to keep it. You have to send that to the IRS. So there is no interest arbitrage that any entity that issues federal tax exempt bonds can benefit from. That fund.
If
those
you,
funds have to go
if it's
to the-
executed the way you described it, but if it's
That's federal
executed,
tax.
well, if it's executed that we pay 1 month at a time in advance prior to their due date, then we hold those funds and we
Yes.
get the benefit of the interest.
Essentially, the bank account and the mud board's interest. Yeah, yeah, yeah.
This before.
Yes.
But the way you describe it is the problem with the system. And what I'm suggesting is that this document be altered to include the fact that we pay 30 days in advance before it's due from the SGRA to whoever the bondholders are. That way, the difference between the amount of money that we pay under the previously issued supplemental agreements, which is 6 months in advance, that we would get the benefit of holding that money and getting that interest. And that's what I object to. And it's not discussed here in any detail.
I would,
Okay.
I would love for you to be able to fix federal tax law.
This is not federal tax.
This is just,
This is the cash flow.
Other items on the agenda, so.
Yes, we do.
Is for it, so
Yes.
why don't we do the item 15? Is that the next one? Sure. Item 15, why don't we talk to the SFDU audit?
All right. This colored map is what we're looking from.
Mhm.
And start there. So Kim and I, over the last 6 months, have gone through and identified all of the parcels, subsections within the service area of Fairway Type 1. We confirmed the land use, we confirmed future demand allocation as identified for undeveloped properties from current use. And we have, like I said, gone through each particular subsection of that region to make sure that it was consistent with what was, identified for that particular, like, for instance, if the sixth and final identified that a tract was going to be commercial retail and it had changed to a restaurant, and we made that change, those types of things. And then also kept track of what has occurred in development over the years on those tracks as well. So we went through that. Like I said, it's taken us 6 months, but we built as part of this Esri GIS database that we now can utilize for future planning to keep track of all these subsections and parcels as they develop or change. Our next step, which was not the focus of this particular task, is to do this for the rest of the woodlands. So we'll have a full-blown GIS database for the whole woodlands for future planning. In this case, we were just tasked to do for Service Area 1.
But what months does this encompass for reclamation facility number 1?
All muds that flow to reclamation.
So Fred, for us.
Yeah.
If you look down, we have no undeveloped property in our section of 46 down in Grover's Mills.
That's in Grogan's Mill.
In Grove, we have a section down here right in the bottom,
Right.
and you'll see it says 46, and you won't see any shaded property there. So we have no, I'm a little surprised, but we have no undeveloped property down there by your chart.
Okay, we'll take a look at which.
Yeah, I think I'll mention one to you. But so, really, we, SFDU wise, we don't have any SFDUs down there. All of our SFDUs are up in Sterling Ridge and, up in the upper part of the
Do we know how this affects the sixth and final numbers or does it?
No, we will once we finish the rest of Woodland, just to focus on the
Okay.
treatment plant one.
Okay.
So what we found on the, change in the undeveloped was really based on mostly all of the commercial area here in Metro Mud. That's where most of the undeveloped properties in this map are from, for the most part. There's no single family in here, and no developable undeveloped property. It's all commercial related, commercial retail, office, et cetera.
Is the vast majority of in Metro Mud or all of it in Metro Mud?
Not, I don't think all, but the vast majority,
Vast
yeah.
majority in Metro Mud.
Yeah, we haven't done any queries to ask,
To understand that.
various data points like that, but what we were just tasked to do is to make sure that there weren't any major abnormalities in, what has occurred since the sixth and final, or anything like that. And then also make sure that the current land use of those, for those allocations is consistent with what's actually there.
So the first page, these numbers are for the entirety of the 10 MUDs or just the page
The only one.
Everything that's on in this map.
in this map?
Just
Okay,
services.
okay. And the increase of about 2,000 SFDUEs was square footage acquired since the last?
No, it was Howard Hughes' estimation of their development of the undeveloped properties within the MUDs. They're
just
they're
upped it.
changing crystal balling from.
Okay.
Okay.
Okay,
Because sixth and final was done in 2017.
Question. As I read this, I'm seeing an increase in the amount of SFDUEs available. Is that a correct statement?
Available now. Increase in SFDUEs required for full development.
For full development, that's the number, okay. And the undeveloped ones, how does this compare to what each MUD purchased over the years?
We won't know that until again, this is just for the treatment plant one.
Okay,
So we need to finish the rest of the.
How many more months? You think
How many
before you get done? Before you
So I'm hopeful that we can knock that out by the summer.
If, I'll just say this, so I know there's other mud directors and other MUDs that are interested in this. And I wouldn't be surprised if they're gonna get together and do a deep dive. If you guys are interested in that, let me know. And I'll make sure.
how does the SJRA view this? If your study here, proven the way it is, demonstrates that there are more SFDUEs available because they weren't utilized as originally planned by Howard Hughes or other developers. Has the SJRA accepted that, this
Again,
concept?
you're using available, that's not the proper, I don't know what you're talking about there. That's not.
I'm not explaining myself well then. Let me try it another way. If MUD 46 purchased 12,000 SFDUEs, and through this analysis, we find out that those 12,000 SFDUEs that we purchased, we've got about, call it 700 and change that are available for sale that we still have on our books, correct? Some number like
Okay.
that, okay? Which means we use some 11,000 and change. Those capacity numbers came from the SJRA and we purchased them from the SJRA since 1985, which is the first purchase of SFDUE. So my question is, if this research says that based on the original plans that we purchased those SFDUEs for, we have now an excess of, call it 200 SFDUEs, has the SJRA reviewed that analysis to make sure we can increase our inventory from 700 to 900 in a hypothetical situation. So they should be part of this, I think.
Yes, well, I think the next step is well, again, this is just for wastewater treatment.
I understand.
So it doesn't relate to the sixth and final capacities that you purchase.
But it will at some point.
It will, yeah. When we finish the rest of it,
Okay.
we'll be able to do exactly what you're asking
Good.
for. And at that point, we can do an accounting of identifying what was purchased per MUD and then identify what the projected needed allocation will be. See if that's a plus or a minus. If there's a minus, you might pair up some minuses with some pluses,
Or we get a refund.
or sure, depends. Yeah, I don't know what the answer will
Well,
be.
to the future ongoing MUD directors, I say, pay some attention to this because it's an opportunity that could slip between the cracks and cost the residents hundreds of thousands of dollars.
Okay, so Let's go to the next item. Where's it at? Okay, discuss potential amendments to district order establishing a policy on reservation of water and wastewater utility capacity.
That's for closed session. Is that right? I don't know.
If you'd like to do that.
So let me, can we go down and finish off the other ones? Because I think once we go to closed session, we won't need to come back. How about supplemental agenda in the attorney's report?
Yeah, nothing on the attorney's report, under the supplemental agenda, if you want me to go ahead and cover that. The supplemental agenda has the adoption of the order canceling the election and declaring the candidates elected. So, David Smith, Stephanie Swantes.
Yeah, we got it.
And Elvin Massoud.
Yep.
Not bad. Are all elected for terms that begin in May of 2026. So, David, you'll be reseated, and then 2 new directors will be seated at that May board meeting when they'll essentially become acting directors of the district. So, do you need a motion on that?
Have a motion to pass that? Second?
Yeah, second.
Second. All in favor, say aye. Aye.
Aye.
Okay. Receive the general manager's report. You got something brief?
Yeah, but really, I would refer you to the packet. I was gonna point out a few things, but it's all in the packet. We updated the spreadsheet that shows kind of how you relate on the water bill and tax rates. That was big. Our ditch crew has been hired and they've been onboarded in training and they're starting to work in the ditches. That was what's there. And then also flushing of the hydrants has begun as water maintenance, water system maintenance. So that has begun as well. That's all I had for communications.
Make it very quick. You got your report on page 78. Just one thing I want to touch on. If you haven't gone through the community survey, that's going to run for about another week. There's a QR there on 78. So QR there and take a look at that survey and we'll bring you the findings next round.
Cool. Thanks.
Thank you.
Okay, Tony, real quick. You want to talk about the global
Yeah,
agreement?
I'll do it real quick. Yeah, we had a meeting a couple weeks ago with Aubrey Spear and his team came and answered some questions about kind of what they were going through as they were going through the settlement, as well as how some of the parameters for the global amendment, just some understanding of that. I thought it was a good meeting. I think folks got an opportunity to answer their question, ask their questions. In the meantime, we've also supplied SJA with the comments that I received from directors as well as some. So that's been sent. They confirmed, they acknowledged that they received those as well as other comments from other GRP participants. So my understanding is they're going through all those and likely in the next few months, we'll, if there's any changes to the agreement wording, we'll get, final version of that for consideration later this year. So,
What I heard you say is the comments and concerns that we had, they will be addressed.
yes, they were provided to them and they'll be going through those.
Okay.
When will they have them back to us by?
I don't, the next few months is what I understand.
I think this is a topic that we probably need to discuss in the coming months more. Okay. Trustees report, you got anything to say other than?
We've talked about most of it already in these agendas, except I did want to point out the trustees did approve us authorizing or requesting an additional 1 MGD of water, surface water from the GRP. Gives us an opportunity to secure that water before the capacity is gone in that plant. And so that'll bring our 50-50 blend to roughly about 58%. So it's a good move.
Question. I noticed through an email that I received that the invoices, the monthly bills for the water will be changed on the back side of it to include a 5th line item. Can you explain that and can you address how that was approved?
Yeah, so to be transparent with the customers, the 11-cent reduction from the GRP that we learned about a month or so ago, that was reduced off of the surface water fee. And then that was equally put into a infrastructure renewal fee as an equal break even. And that's the fee that Brian was talking about earlier that would potentially be utilized to buffer this 47 cents or whatever it ends up being.
And that's the reason why you wanted to change the 50-50 split to more surface water, because that would have, okay,
It has nothing to do with,
nothing to do with it.
both are
Maybe you could
completely independent.
address the reason for that.
For what?
The
water.
the recommendation to change the water percentage from 50-50 to a different number.
Yeah, I had received many requests from directors across the Woodlands for interest to increase surface water conversion. When I started seeing that the GRP was receiving significant requests from across the county from other GRP members to secure additional surface water, to the point where the 30 MGD plant was coming to its capacity.
Right.
And so they were going to be running out of essentially available additional water for any municipality to receive. So I thought that it was a good idea to.
But the net result is a reduction of rates theoretically to the customer, correct?
No,
If
again,
you
it has
increase,
nothing
if you
to do-
increase the number of the amount of surface water and it's charged at a lower rate, and the groundwater is charged at a higher rate, if you change that percentage, then obviously the cost will go down or up depending on which way you change it.
Right. So if we take a higher percentage of surface water, it's about 2.5 to 3 cent increase in the blended rate that you pay now. If we go into that.
Surface water costs more than groundwater. In your example, it was flipped. Surface water costs more and you're taking a higher percentage. Groundwater costs less, you're taking a lower percentage.
We're now going to a lower groundwater. Is that correct? Or did I
You're
misunderstand?
going to a lower groundwater, which
Yeah.
has lower fee, and you're increasing surface water, which has the higher fee.
Correct. And the net result of increasing,
Correct.
just letting the ongoing board members know that.
And the 47 cents that you were talking about, that was the number expected if we were to approve the bond? Was that where the 47 came from?
Yes.
Okay.
That's per thousand, correct?
Yes, per thousand.
Per $1,000,
No, per thousand gallon.
per 1,000 gallons, 47 cents. Okay, out of which 16 cents would be interest payments. Yes. Okay, got it. Thanks.
Okay. So trustees report. So I guess we're back to number 16.
Can I ask? Question.
Okay.
You had that meeting with Aubrey.
Yes,
Who from this board went to that meeting?
I was there.
Okay, did you invite anyone else?
I think I might have been
You were
invited. I
there. You
didn't-
were supposed
I
to, you
didn't
didn't show. You didn't show.
No.
You only have two, so it was Joseph and myself.
Okay, I was just
Joseph,
wondering
you
if my concerns were addressed. But I guess they were.
Okay, so closed session?
Yeah.
Okay, we will close the general meeting. Meeting's closed. Yeah, after everybody leaves, we'll open the closed meeting.